If you were to start a hedge fund today, who would you have on your team? A couple of Michael Jordans and a couple of Lionel Messis? That's what this fund did. Backed by the brightest minds in finance and billions in capital, on the brink of causing a global financial meltdown. This isn't fiction, it's the true story of long-term capital management. Today, we're diving into one of the most astonishing tales in financial history. We're going to look at the meteoric rise and fall of long-term capital management, and also talk about how a fund of this size almost took down the entire global economy. Founded by John Meriwether and involving Nobel laureates such as Myron Scholes and Robert Merton, Ltcm was not just another hedge fund. It was a financial behemoth, envied and revered by everyone in the industry. Let's turn back the clock until the early 1990s. The financial world was buzzing with innovation and a new hedge fund was making its stride onto the scene. Long-term capital management was founded in 1994 by John Meriwether, the former vice chairman and head of bond trading at Salomon Brothers. Meriwether was a legend on Wall Street, known for his sharp intellect and his astute trades. But what truly set Ltcm apart from its competitors was the star-studded team. Myron Scholes and Robert Merton, two of the most celebrated minds in finance and economics, were on board. Both would later win the Nobel Prize for their work in financial derivatives. This wasn't just a hedge fund, it was a dream team of the finance world. In its early days, Ltcm was the golden child on Wall Street. It promised to use sophisticated mathematical models to reap rewards from inefficiencies that they found in the market. It was arbitrage on a scale never seen before. Ltcm's strategy revolved around what's called convergence trades. And this is basically a bet that the difference between two related assets is going to diminish over time. This strategy relied heavily on leverage, which is borrowing money in order to amplify your investments. Their approach was groundbreaking, and in the beginning it was wildly successful. By 1995, just a year after its inception, Ltcm boasted profits of 43% after fees. So this would be the same as your team of Michael Jordans winning their first season. The financial world watched in awe as this star-studded team basically rewrote the rules of finance. But as we know, high returns in finance also often means that there's high risk. And behind Ltcm's impressive gains lay the seeds of their eventual downfall. Let's take a little bit of a closer look on the strategies that made Ltcm so wildly successful in the beginning. Understanding these is key in also understanding how a fund so successful also managed to collapse so fast. Like I said earlier, Ltcm strategies were basically mathematical models. And what they would do is that they would try to predict small inefficiencies in the markets that they could leverage due to both having capital and also being fast. These inefficiencies were so small that if you as a retail investor tried to do it, it wouldn't work, because the price differences are so small that in order to make it work, you need high amounts of leverage. One of these strategies was fixed income arbitrage. Now what this means is that you would buy one security and sell another, and you would wait for those prices to converge in order to gain a profit. But this is where it gets interesting. Because of the inefficiencies that they were able to find were so small, they also had to amp up the leverage to massive amounts in order to make it profitable. So at their peak, the leverage used by Ltcm was 30-1. This combination of sophisticated mathematical models and extreme leverage worked like a charm at first, earning the fund lots and lots of returns and gaining the confidence of almost everyone in the industry. It also bolstered the confidence of the people working at Ltcm, seeing that their models were able to accurately predict the market. As we'll see in the next segment, when financial storms hit, Ltcm's reliance on stability and predictability were severely tested. The first signs of trouble came from far beyond Wall Street, and in 1997, Asian markets started having huge problems. Countries like Indonesia, South Korea, and Thailand experienced severe financial distress, which had a domino effect worldwide. Ltcm's models, sophisticated as they were, assumed that markets would remain stable and predictable. But the crisis in Asia showed that markets are still unduly influenced by large geopolitical events that are mostly unforeseen. The fallout from the Asian crisis was just the beginning, however, and in 1998, Russia defaulted on their debt. The Russian default was a seismic event in finance, and it sent shockwaves all throughout the industry, and particularly hurting Ltcm. Ltcm had placed significant bets on Russian government bonds, betting that the situation would stabilize. But as these bets turned into losses, the financial loss on these bets were magnified due to the extreme leverage that Ltcm had. The Russian default was a very clear example of tail risk, a low probability, high consequence event that Ltcm's models failed to account for. Their strategy was like a house of cards, exceptionally profitable under calm market conditions, but at the first sign of market upheaval, everything started to collapse. The combined impact of the Asian financial crisis and the Russian default was a brutal 1-2 punch for Ltcm. We've now seen some of the shortcomings of Ltcm's financial models, and by the summer of 1998, they were in a really precarious situation. Their highly leveraged positions became increasingly untenable. This was not only due to the financial crisis that the world was finding itself in at that time, but it was also due to investor confidence, which is key when managing expectations and investments for other people. This situation escalated really quickly, and LTCM started seeing mounting losses month by month. And just in the 4 months between May and September of 1998, LTCM lost a staggering $4.6 billion. But it wasn't just the size of LTCM's losses that was a problem, it was the speed. Because this was happening so fast and LTCM was entangled with so many other assets like government bonds, their stability quickly became an issue of national security and financial security. This might be something that you've heard before when you think back to the 2008 financial crisis or the 2023 banking crisis, and this happens all the time in financial crises. The markets are very interconnected, and one collapse in one part of the world can have large effects on others. The biggest fear was that the collapse of LTCM would trigger other collapses in other parts of the financial industry, specifically within banks or other trading firms, and everything else related or touched by LTCM's money. In order to remedy this situation, the management of LTCM tried to frantically save their firm, and they started asking many different banks for capital injections as well as limiting investors' withdrawals. But the scale of LTCM's problems was just too great, and the confidence in LTCM as a fund had also fallen dramatically. In the midst of this crisis, Warren Buffett actually made an attempt to buy LTCM. He banded together with investment bank Goldman Sachs and offered LTCM's management $250 million for the firm. One of the stipulations of this offer was that a decision had to be reached within 1 hour. So the board and the managers of LTCM scrambled together in order to try and come to a decision, but they didn't manage to reach consensus. Which, if you think about it, is kind of funny, because LTCM was built on speed and aggression, and they didn't manage to make this decision, losing out on $250 million and being saved by Warren Buffett and Goldman. Enter the savior of the day, the Federal Reserve. The Federal Reserve banded together with a lot of the Wall Street banks and actually bailed out LTCM to the tune of $3.6 billion. This was a controversial move, but the Fed said that they bailed out LTCM in order to stave off an imminent global financial collapse. But this did, however, set a dangerous precedent that we saw would be followed in 2008, where the government would bail out financial institutions and put the bill to the taxpayer. Post-bailout, LTCM actually was still under operation until the year 2000 when it was dissolved. So LTCM's collapse is a stark reminder that high volatility as well as leverage can be pretty dangerous in financial situations. And if you're interested in reading more about LTCM's specific collapse, there's a book called When Genius Fails, which goes through this entire process from start to finish. To get some value from LTCM's collapse, we need to take a look at some of the lessons learned. And the most important lesson and takeaway from this video is to like and subscribe. In all seriousness, one of the most important lessons, and probably the most important lesson, is to not mess around too much with leverage, because you can quickly end up in a situation where you lose everything or more than you bargained for when entering a trade. Leverage, by definition, is very dangerous, because you look like a rock star when everything is going well, but you look like an absolute idiot when it fails. Just take a look at Bill Hwang, who lost over $10 billion in a day because he was leveraged 300 to 1. And as a result of the LTCM collapse, a lot of regulators around the world started asking for more transparency into hedge fund positions and also leverage sizes and risk management. These introduced regulations aimed to both keep markets stable and also protect investors. Academics and practitioners started questioning the reliance on historical data as well as models that assumed that the markets were efficient and normal. There was a growing recognition of the concept of tail risk and the impact that they can have on your portfolio or on your fund. And if you want to look at a person who has actually made it and has challenged Warren Buffett in being named as the absolute GOAT of finance, you can take a look at Jim Simons from Renaissance Technologies. LTCM's story is a tale about the limits of human psychology in finance, and it also illustrates really well that the most sophisticated of mathematical models can't predict human psychology. This is actually a concept known as the map is not the territory. So this is a mental model that tries to say that a map is very different than the actual thing it tries to represent. And we can say the same thing for financial models, where the model might be good at predicting some things, like for example when the market is stable, as in LTCM's case. But when things start going awry, the model fails completely. If you're interested in learning more about mental models like the map is not the territory, please take a look at our video about 5 mental models that will improve your investment journey. The story of LTCM shows that even the smartest guys with a team of Nobel-winning economists failed to tame the beast that is known as leverage. And this only emphasizes the Charlie Munger quote, "There's only 3 ways a smart man can go broke: ladies, liquor, and leverage." And with that, please remember to like and subscribe. And until next time, See you guys.